All right, welcome back to Bloomberg Open Interest. A quick check on the market. We're about 16 minutes into the session, and we do have some green to talk about. The S&P 500 up by about 0.1%. It's interesting to see the NASDAQ 100 lagging right now. You now have Meta shares higher, as well as Broadcom, as well as Apple, but still the benchmark overall unchanged. And then you take a look at the small caps. Just can't get out of bed on this Friday. The Russell 2000 currently down by about 0.2%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Netflix getting raised to a buy over at Bernstein. The analyst cites increasing subscriber growth and increasing operational leverage, with the streaming giant reporting nearly 19 million new subscribers earlier this week. Next up, we have Guggenheim Securities upgrading Restaurant Brands International to a buy, saying that the stock's recent slump is overdone. The analyst says that management is making the right strategic moves. That's good for about 0.1% gain, 0.8%. Again, happy Friday. Finally, a different story over at Brinker International. That is the parent company of Chili's. It's getting a downgrade over at KeyBank Capital, with the firm cutting its rating from a buy, saying that the stock's valuation leaves little room for error and is well beyond a realistic bull case scenario. Harsh words translating into a 2.5% drop. This is Bloomberg.
It's time now for the Wall Street Beat. The hedge fund world will converge in Miami next week at Global Alts 2025. Brian Corbett, President and CEO of the Managed Funds Association, joins us now from Washington. We'll be in Miami. I will be too. There are a lot of people headed down there, really from around the world. But I do want to start with where you expect a lot of the attention to be focused, because of course we are now past week one of the Trump administration. Right. You have put forward a lot of priorities when it comes to the acting SEC chair in the meantime. But if you had to kind of hone in right now, just to priority number one, what is it?
Yeah, I think the priority is to really turn the page on the Gensler regime and move forward with policies that are focused on supporting our public and private markets. Let's reduce the red tape that's been put in place over the past few years. Let's stop regulating by enforcement. I'd say secondly is embrace alternative asset managers as an important market participant that helps drive economic growth. And lastly would be to support pro-growth tax policies like preserving the current treatment of carried interest, which is important to innovation and financing small and medium-sized businesses.
You know, it's interesting. Some of the rules are already in place. Of course, there was a lot of rulemaking that happened under the former SEC chair, and you had really contested a lot of it. It got quite litigious.
Yes.
Are there some rules that you'll look to eliminate? I know that you're already asking to delay, for example, some of the compliance reporting deadlines that are associated with some of the more recent rules put forward. Would you look to get those completely eliminated instead?
So you're absolutely right. Under Chair Gensler, there were 20-plus rules targeting our industry. We sued on 3 of them. We won 2 lawsuits. So as we move forward, we are asking immediately for Acting Chair Mark Uyeda to delay implementation of 2 of the more problematic rules. We're also asking him to withdraw an appeal. On the last day in office on Friday, Chair Gensler appealed a court case that we won, and we are asking the SEC to immediately withdraw that appeal.
Yeah, it seems like it was a rush to the finish for the SEC last week. I want to talk a little bit more about these new rules, because one of the concerns that you express is that it could increase concentration risk in the hedge fund industry. But new rules aside, is that a concern for you anyway?
No, I think markets are competitive. There's new market entrants. One of the concerns we've had, frankly, with all of the Gensler regulation over the past few years is that it was such a heavy overhang on the industry that you actually saw the SEC causing concentration because of their rules. It was too costly, too expensive for new funds to launch. So as a result of what the SEC did, the big were getting bigger. So we think it's important to reduce that regulatory overhang and create, once again, a vibrant market system where you see a lot of new entrants and you see creativity in the markets.
Well, that's an interesting point to make, because then do you see new funds going to come to market this year at scale? We have already seen a lot of that last year, despite the regulations.
Yeah, I think so. It's a growing industry. You've seen alternative asset managers continue to be an important part of the portfolio mix for allocators, whether it's pension funds or endowments. So we think there will be continued investment appetite for supporting alternative investment funds, and we think you'll continue to see new launches as new investors come to market with interesting investment strategies and ideas.
Brian, is there anything that you would applaud from the Gensler administration? I know that there was a lot that was really disputed, as we've been talking about, but what's going to stick?
Look, in terms of applauding, I think he took a very broad approach and really pushed industry out of the process. One of the things we are focusing on is not only let's go back and look at all of the rules that were passed and where we can make changes, but let's change the process. It doesn't have to be so adversarial. You saw Chair Gensler use regulation by enforcement as a tool to kind of find foot faults for companies and bring lots of enforcement actions. You also saw him push industry to the side when he was doing his rulemaking. He didn't look to consult before he proposed the rules. He had his vision, he proposed it, and in many cases, he was taken to court and lost. So we think there's lots of things that can be done to change that adversarial relationship and create a more effective and efficient regulatory system.
Yeah, it seems like across industries, there's a lot of people that are happy to see Chair Gensler, of course, vacate the post there. But I want to move on from just the SEC. Let's talk a little bit about Congress, the new administration. What are your potential worries there? Obviously, there's a lot of opportunity that's been expressed, but what concerns might you have?
We're looking forward to working with the new administration, certainly with Secretary-designate Bessent, with Paul Atkins coming into the SEC. You see policymakers that have a lot of market experience. They have industry expertise, and they're focused on pro-growth economic policies. And we think that's really the important factor here. President Trump ran on and is looking to implement a pro-growth regime. As Congress moves ahead with tax policy, as I noted earlier, certainly making sure that we continue to focus on pro-growth tax policies will be an important part of our agenda.
You know, I think about the rules around short selling that we've seen in recent years as well, and then a number of short sellers shut down or reduce their activity. We only have a minute left here, but do you think some of that can come back to the market now that we have the potential in the new administration for a rollback of rules?
I do. I think short selling is an important strategy for investors. Many are looking to mitigate and offset risk, and they do that through short selling. Oftentimes, short sellers are the ones who detect fraud and inappropriate activity at companies as well. So we think it's an important tool with some of the rules that are being sued and where there is litigation, like the short sale rule and the securities lending rule paired together. We're optimistic that you will see shorting remain an important strategy in the markets.
All right, Brian, up against the clock. Got to leave it there. Great to speak with you. That is Brian Corbett of the Managed Funds Association. Now, coming up in the next hour, Verizon CEO Hans Vestberg joins us. Don't miss that conversation. This is Bloomberg. All right, we are 30 minutes into this Friday trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and coming up, the S&P 500 is headed for its best start for a new U.S. president since 1985, as Trump talks up growth policies and softens his tariff stance. And we're going to round out the earnings week with insight from the C-suite. Verizon CEO Hans Vestberg joins the show after reporting results that topped estimates. And Vanguard's S&P 500 fund is on the brink of becoming the world's largest ETF. We're going to take stock of VU's rising popularity. And Katie, we're looking at these markets.
We are looking at these markets, a close eye on that rally that we've seen in the first week of the Donald Trump administration. Building a little bit here. Of course, we hit that record high yesterday. We're technically at a record high rate now. All that matters is that we go up. The scale doesn't matter when we're at these levels. The S&P 500 higher by about 0.1%. The NASDAQ 100 finally paying attention attention to the rally underway that's going in Meta. The NASDAQ 100 up about 0.1% as well. The bond market still quiet. Of course, we are above 460 now, knocking on the door of 465 when it comes to that 10-year Treasury yield, but still pretty much unchanged on the day, Sonali.
It's interesting to have gone round robin. Want to also bring you some breaking news on home sales data. December existing home sales have risen to 4.25 million. The estimate was just 4.2, so we're pretty much in line with estimates here. Of course, those mortgage rates have remained high. It looks like some people might be getting used to it. Now we're going to switch back to these markets. Joining us now, Ann Berry, Threadneedle Ventures founder, and we're looking at Meta today. We have to. That estimate that they put out for how much they might spend on CapEx is going to set the tone for everything that we see next week in terms of big tech earnings. How did you feel about Mark Zuckerberg wanting to put another $65 billion on the table for CapEx this year?
Well, I think this is in keeping with the risk of not spending CapEx is less than the risk of actually going and spending more. But I think there's something that I'm worried about this, Sonali. It's not that it's setting the tone of the quantum of CapEx. It's the data that's missing around this that I fear is setting the tone for a bubble here. And this is what I mean by that. When you're in a board meeting, here's what usually happens when people talk about CapEx. The board will sit there and say, what is the return on investment, right? What is the yield that you're expecting from these dollars going into the floor? And I have yet to hear any of the big tech companies talk about what these dollar return on investments are going to be when we know they must be having these conversations, at least at the board level, and certainly going into the budget. So that's what I'm concerned about.
Well, you think about Meta in particular, and Mark Zuckerberg owns so much of the company. Yeah. That concern at the board level, specific to Meta, are you saying that it might not be addressed?
Well, I'd like to see the numbers, right? And it's not just there. We should see it at Alphabet. We should see it at a lot of these other companies where these CapEx numbers are huge. Now, I do think Alphabet, for example, does have a great track record in terms of capital allocation and capital discipline. And Ruth Porat does have a tendency to talk about return. We don't tend to hear this from Meta, and here's the cautionary tale. When all the spend was going into the metaverse, we also there did not hear what the return numbers were going to be. We heard descriptive, qualitative descriptions of features, but we didn't know what the return, what the dollar yield was going to be, and quite frankly, we haven't seen it. So that's my concern when it comes to Meta, and yes, maybe, because you've got a controlling shareholder, you get that obfuscation.
Well, you have to wonder if some of the new board members care that much about CapEx as well. They like to be spending money.
Is going to be asking all about this.
Hard to think about.
All those tough questions.
Right. And so you think about what we might see next week. How do you prepare for it? Because we did have a market that finally hit past its record once again, but you are seeing some nervousness clearly still under the surface here. Do you think that investors will react like they have today to Meta's announcement if you do see the numbers and the ROI not proving what they're putting down?
I think that we'll see some of that. It depends on the sector, Sonali. So I think you're getting, and we're seeing it with Amex, right? It's down. It had actually a pretty strong quarter. I think the companies that are in tech that are given the benefit of the doubt, where the assumption is they know what they're doing with AI, will probably do well as long as they're seeing beats and optimistic forecasts in their earnings. For the non-AI, the non-pure play tech companies, I think it actually could be quite a punitive earnings season. I think that if you are seeing misses on costs like you're seeing at Amex, if you're seeing a lack of return, if you're seeing integrations not delivering, I think that's where it gets harder. And if you take a macro look at the equity market right now, the risk premium is zero, perhaps negative, which is just astonishing. So I think if we don't see the results in this earnings period, at some point this euphoria train we're on post-election, I think, runs out.
I'm glad you brought up the equity risk premium, because this is a question I've asked before, and it's how do you make a decision based on that? I know that, of course, in any reasonable portfolio allocation strategy, it's just one of several factors, but I mean, how do you actually factor it in? I assume you're not going to go from stocks to bonds just based on this measure.
No, and also because if you actually look at the risk premium, when you look at bonds also, they're very compressed, right? So actually finding risk-adjusted returns in either set of asset market is really difficult to find. So I think it's really looking for alpha. It's really looking for esoteric decisions around stock picks. I think it's gone beyond looking for industry themes. I think people are aggressively now looking to look at individual names in a way that they weren't doing over the last 2 years.
So let's recalibrate your top picks today.
Yeah.
Now that we know what we know now.
Yeah. So I've got two, and they're completely different worlds. One is a theme that I've talked about on the show a lot, which is live entertainment and the hunger for it. Now, when I looked at Netflix come out, here's what was really profound: the impact of sports and the take-up and the impact of subscription. So I went from looking at Netflix, which I've been in for a long time and been a big fan of, and I've actually bought into TKO, which owns, back to what we were just talking about with Meta, UFC and WWE. UFC media rights are coming up at the end of this year, next year. I think there'll be outsized demand for it. I think they'll aggressively go into creative new leagues. I've invested in new sports leagues privately, and I think TKO's got some upside for that purpose.
That's really interesting, because when you say live entertainment, some people think of, you know, concerts, actually going out and going to sporting events, but it sounds like a lot of this is tying into, you know, actually just watching it on your TV.
I think it's both.
Yeah.
So I've also invested in the venues. We've talked about that before, but the fact that that is translating into demand, particularly amongst the streamers, for unscripted events where there's uncertainty, where there's fandom, right? It's the fandom and it's the repeat subscriber who comes back to be able to see their favorite teams playing or their favorite wrestlers dancing, choreographing. Then I think that's the kind of thing that the streamers will go after and will spend money on, and TKO, I think, is well positioned.
I will say this. A year ago, I was not that excited to watch the Commanders clobber the Eagles, but this weekend I will be.
Oh my God.
I know. I can talk about football now. I don't know when that happened.
I have a lot of affection for Philly, so I don't know. But Anne, it's always great to see you. Have a great weekend when you get there. That, of course, is Anne Berry of Threadneedle Ventures. Now, coming up, speaking of earnings, Verizon posting a strong fourth quarter and shooting the stock higher. We'll speak to Hans Vestberg. He is Verizon Chairman and CEO next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. President Trump softening his tone on tariffs against China, saying this on Fox News: "We have one very big power over China, and that's tariffs. I'd rather not have to use it, but it is a tremendous power over China." The yuan jumped against the dollar on the suggestion of a 10% tariff rather than the steeper 60% tariffs Trump previously mentioned. And JP Morgan CEO Jamie Dimon got a pay bump in 2024. Dimon earned $39 million in salary and performance-based compensation, up 8.3% compared to the year before. In the same year, JP Morgan beat its own record for the highest annual profit in the history of American banking. And Diageo, the company that owns Johnnie Walker and Guinness, is said to be reviewing its drinks portfolio to reignite growth. It is already looking to sell its vodka brand, Ciroc. According to people familiar with the matter, it's also studying the spin-off or sale of Guinness. And Tesla unveiled an update to its best-selling Model Y in the US and Europe in an effort to revive sales. The redesign borrows elements from the Cybertruck, including the full-width LED light bars, and also improved aerodynamics and better soundproofing. The EV maker looking for a turnaround after reporting its first annual sales decline, Katie, in over a decade.
I will say the Cybertruck looks awesome. That's my unbiased opinion. I don't know about that redesign. I don't really like the light strip, but again, Elon Musk didn't ask me. Let's talk about Verizon. A strong fourth quarter is powering Verizon right now. Shares higher to the tune of about 0.9%. The company reported numbers this morning that beat analyst estimates. Also saw strong gains in new mobile phone and broadband customers. Let's break it all down, the quarter that was and the future, with Hans Vestberg. He is Verizon chairman and CEO, joining us now. Hans, great to have you with us. Let's go to subscribers, because you reported a net gain of 568,000 monthly phone subscribers. The expectation had been for below 500,000. So from where you're sitting, where do you think that those gains are coming from?
So I think, first of all, we have a great offering. We had a very strong quarter, both financially and operationally. We added actually 1 million new postpaid customers on broadband and wireless together. And as you rightfully said, on the wireless side, 568,000. Very strong quarter. We have great offerings in the market. We have the best network that is supporting that. And we have gradually improved now over 5-6 quarters, sequential improvement, both operationally and financially. So we not only had a great operational quarter, but we also continue to expand our margins, and our cash flow for the full year was $19.8 billion. So very strong financials with a really solid growth on customers as well. So I think the products resonate with the market today more than ever. I mean, you cannot work, live, play without mobility and broadband. And I think we are meeting that as the largest carrier in the country.
You know, in addition to earnings, you also announced a new AI initiative as well. And how do you feel about the customers that you're bringing on when it comes to AI Connect? Because is this something that you believe will be a significant growth driver?
Yeah, definitely. But think about this. I mean, today, the majority of Gen AI is large language models being developed in enormous large data centers. When that's going to be applications for enterprises to use, they're going to go further out in the network, both for the transport cost, for privacy, security, latency. We have already those assets. We have compute, we have storage, we have cooling, we have power. We already have that in our system that we can host. And we already now have customers like Google, Meta, that is using our network for their AI work, you know. So this is just the start of it, and the second phase is going to be way out in the network. And then Verizon, which have fiber across the whole country, have also space and cooling, and as well as power. We have a lot of power that we can resell as well. So all that is creating a new business for us on existing assets that we don't need to develop. They're already there. So it's a great opportunity with the big announcements of Gen AI and data centers in the country. And US is the leader here and will be the winner on Gen AI. I think we're in a great position to be part of that.
Well, Hans, corporate spend is the theme of the morning, of course, with that big announcement from Meta. When it comes to this opportunity that you see in AI and your ambition to be the leader when it comes to Gen AI, how much are you willing to devote of CapEx to that goal?
So, as I said, the majority of what we have, we already have done it. We've already deployed one fiber strategy. So we have fiber going around across the country, close to data centers, close to all the enterprises. We already have space. We have capacity of power that we can reuse. So much what we have is already invested. So we think about the second part of Gen AI when the large language models are already developed and you need to be closer to the user, the company, the enterprise, or whatever it might be. And they were well positioned. We already have revenues from it today. We had in the fourth quarter, even though we're small, we're now ramping that up. And that's why we announced today AI Connect, which is our product and solution for this.
I'm also just curious about regular way internet, because if you look at the internet subscribers that you brought on, the rise, or it was a decline from a year ago, but it was more than what analysts expected. And so what does that mean about the prospects of the people you are bringing on and what it means for the upcoming quarters?
So I think that our broadband strategy that we laid out in the third quarter is really resonating with the market. We have two great products. We have the fiber product called Fios, which is I would say the highest quality fiber product in the market. We have great success with that. We added 50,000 new customers in the quarter. Then we have fixed wireless access, which is a totally different model where you self-install, you have great performance, high customer satisfaction. We added more than 370,000 of those in the quarter. So all that product is going into next year or 25, we're already in next year, to fortify that. And then we have our pending acquisition of Frontier that is adding even more fiber customers. So our broadband strategy is clear. We're taking share at the moment, and we think we can continue to do that into 25.
Let's talk about the share price a little bit, because I'm taking a look over the past 5 years, and I see Verizon shares down about 13% on a total return basis. Hopefully we'll have that chart up. And I want to ask, Hans, I mean, what do you think that investors are missing when it comes to your story? And why are we seeing this sort of sideways chop when it comes to your shares?
I think if you look at our share price, I mean, it's always a lot of different combination. I think we, of course, invested heavily in the 5G and in Spectrum, and we took on a lot of debt during the Spectrum acquisitions in 2019. Now we're working that down. We're almost down to our debt leverage of 2.25 on net debt to EBITDA. So we are actually paying that down. So I think that our capital allocation has been heavy to build our network and now getting leverage on that. And that's what you see, and that's, I hope, what our shareholders will see, that growth trajectory can continue and we get leverage on it. Secondly, we are on the 18th year of increasing our dividend. I mean, there are not many companies that are doing that, and of course our yield is high today, given that the share price is a little bit subdued. But I think that's what our shareholders should see, and the prospect of shareholders, both that the dividend has been super stable and growing, and then now we also continue to grow both operationally and financially. So I have high ambitions here, and I hope that every stakeholder is going to see that.
Certainly, the debt load was something investors were keeping an eye on, and as you have made a lot of progress in terms of reducing that load, I do still wonder, you had come off an announcement of a massive acquisition. Do you see more potential acquisitions? If you're able to tap the capital markets or fund it otherwise, wondering what your inclination here is to do more to expand your reach through mergers and acquisitions.
So our strategy is pretty simple. We build one network, and we want as many profitable connections on top of it in any type of the segments of the market. Today, we are the number one on wireless. We have a nationwide, so we already have it. So now it's just to continue to get leverage on. On broadband, we just acquired or in the process of acquiring Frontier. We have a great broadband offering. We're planning to address 100 million households with our broadband offering. So I think we're sitting really good with assets we have, and that's what I want to execute on. As a CEO, you can never say you're never going to do an acquisition, but clearly we have all the assets right now, and now we are in execution mode and see that we leverage that.
All right, Hans, really appreciate your time. That is Hans Vestberg of Verizon. Meanwhile, still ahead, we have another C-suite conversation. We'll discuss the live entertainment industry with J.W. Roth, the CEO of Venue. That conversation coming up next. This is Bloomberg. All right, welcome back to Open Interest. Let's get a quick check on these markets right now. Dipping lower on the big indexes right now. Of course, we got some economic data out at the top. We got those final January numbers coming in a decline for the first time in 6 months. You can see that sentiment trickling through right now. The S&P 500, the NASDAQ 100, now both lower on the day. And you can see the bond market finally waking up, finally reacting to something. But little moves overall. The 10-year Treasury yield now down about 1 basis point that is, singular there, because it's a quiet session overall.
It is a quiet session, but we have, as you've been talking about, have remained above 460 on the 10-year. For more, we are joined by Michael McKee, Bloomberg's chief international economics and policy correspondent. When you look at the health of the consumer right now, there are clearly so many fears about inflation expectations. When is this going to be a bigger deal? It seems like it's already starting to be.
It's starting to be, and the University of Michigan basically says this comes down to one person, Donald Trump. This survey went through Inauguration Day, and what it shows is people are afraid of two things: higher inflation brought on by tariffs, and the idea that maybe the labor market is softening and their job prospects won't be as good next year. They asked people about tariffs, and only 19% said they thought higher tariffs would be a good thing for the economy. 62% say they favor lower tariffs or no tariffs. So that's a big issue for people out there. The only thing that the Michigan people say kind of offsets this is that we have seen essentially strong consumer spending. So people are not acting on these issues yet, but it's something to keep an eye on.
When it comes to these surveys, do levels matter here? Because we're above 70, we're above where we were this time last year, even with this slight decline. I mean, how much should we read into this?
Well, you've got this survey and the Conference Board survey, which comes out next week, and they both use different scales. So the level doesn't matter so much as the direction and the speed of the move. And the fact that we've gone down for the first time in months says something about where people are. It looks like they're more nervous about the future than concerned to the point where they pull back. But they're keeping an eye on things. They're not maybe going to spend as much on big ticket items while they wait to see how all this works out.
How much is real and how much is rhetoric? I'm looking at, for example, Torsten Slok's note from this morning that charts these inflation expectations from the University of Michigan by political party. And what you see is the Democrat expectations have just soared for inflation, while Republican expectations have declined quite meaningfully. So what's real at the end?
Well, Americans are very bad at guessing what inflation is, although in recent years they hear the numbers all the time. So they're maybe a little bit more on top of this. But that's what always happens. Whenever there's a change of control in Washington, there's a change in the view of the economy. And in this case, today we see Republicans are much more optimistic about the economy. Democrats are much more pessimistic about the economy. But the interesting thing is that Republicans tend to answer the survey more, according to the University of Michigan. So they carry a little bit more weight. So the fact that we've seen inflation expectations in the next year rise, and they stayed at 3.3% in the final survey, does suggest people have inflation on the mind. Now, gas prices have gone up a little bit, so maybe that's part of it, but it's something to keep in mind.
We know a lot of investors watching it closely. RBC's Lori Calvasina even saying that it's been high up in her investor presentations. Bloomberg's Michael McKee, we thank you so very much for joining us this morning. Coming up, we're going to talk about live events, talking about the consumer a little more, because Venue is looking to raise the bar. We're going to speak to the CEO of the company next. Stick with us. This is Bloomberg. Venue Holdings is looking to strike a chord with investors. The live entertainment company debuted on the New York Stock Exchange in late November. Venue now announcing a new expansion of its entertainment facilities over Texas and Oklahoma. Here with more, J.W. Roth, Venue Holdings CEO. When you think about these locations that you want to expand into, what are the number one things for each of these locations that really brought you there at the end of the day?
Well, ultimately, it's there's a couple of things. There's first, it's demand, and it's the opportunities that provide itself in markets that are underserved by live entertainment. So that's number one. Number two, it's the public-private partnership, right? So we build our venues in partnership with municipalities across the country, and the municipalities that we have chosen fit a certain demographic, and it fits a routing schedule where we want to build our venues.
Well, talk to us a little bit about that demographic. Obviously, taking a look at some of the guitars that you have behind you and reading up on the country, it seems like country music is the name of the game. Give us a lay of the land and the opportunity set you see there.
The music industry is roaring, as you know. There's never been a time in history where ticket demand has been higher than it is right now for live music. And there's never been a time in history where the supply of new artists is higher than it is today. Live music is the #1 leisure activity in the world. And so where we saw the opportunity was in the exchange, right? Where fans meet artists, and that's the venue. And so we set out to build premium venues. We just built what I believe is the most luxurious venue in the history of our country here in Colorado Springs, opened this last summer. We did a deal with the Ford Motor Company. Ford put their name on it. I think they paid the highest naming rights in outdoor live music, and it is by far one of the most premier venues ever built. And so we are doing that same exact thing in Broken Arrow, in the Tulsa market, McKinney in the Dallas-Fort Worth market, El Paso. We have 7 more that are under development right now. And so we're excited about changing the live music experience. Live music is about experience. It's about ambiance. And so we have just felt like the venues throughout the country are old. They're in disrepair. Just think about this. The average amphitheater is 40 years old. It was built back before rideshare, before elevated food and beverage. And so, we're changing what we believe the customer and the fan is demanding.
So I've actually specifically traveled to Tulsa for concerts before us on my 30th birthday, but the venue I was at didn't have fire pits. I want to talk a little bit of the video we just saw. When I walk into a venue, what can I expect?
You can expect over-the-top ambience and over-the-top experience. I've been a music fan my entire life, and so in my backyard, I built a big fire pit. And, I have a fire pit that will hold 50 people, and we have a bandstand in the backyard and so on and so forth. So when I decided to go build these, I decided to build them with the experience that people would enjoy as if they were watching a great concert in their backyard. So I sprinkle fire pits throughout my venue. I build clubs inside my venue. I partner with Troy Aikman of the Dallas Cowboys to build the Aikman clubs in Oklahoma and in Texas. But the video that you're watching right there is Colorado Springs. That's 92 fire pits that are sprinkled throughout the venue. It creates unbelievable ambiance. You have cocktail service, elevated food and beverage directly to your suite. My wife, she always complains when we go to venues. It's a long walk to the girls' bathroom. And then once you get there, there's a long line and all of these things. So I built it so that it would be like if you were having a concert in your backyard. The bathrooms are close, great food and beverage, great ambiance with a fire pit suite. And then in the summertime when it's hot, you don't want the fire on, then there's an insert that goes inside the fire pit suites full of ice and cold beer. Doesn't get any better than that.
I know, and the restaurant fees you get from food and beverage account for a lot of what you bring in the door, but the other part of that comes from ticketing. Something I'm wondering about is there's been a lot of frustration in this country in the way tickets are sold through the power of the big ticket providers. I mean, how do you view this issue as a large venue provider?
Okay, it is an issue. It is an issue that is outside of the venue's control. So, the ticketing piece of the space is getting better. I think Ticketmaster is getting better. I think Access is getting better, and they are working diligently. I see what they're doing on the backside, and I think they're working diligently to bring more controls. In other words, the issue a lot of times in ticketing is the second sale, right? So it's the sale of the ticket. That's usually fairly smooth for the most part. It's then the secondary markets that create the havoc. And so we are watching processes come into place that is going to tighten that up. It is not something venue controls, but it's something that venue watches very closely.
I want to talk a little bit about your decision to IPO because, as I'm sure you know, there haven't been a lot of IPOs, especially of smaller companies, in recent years. So Venue, you have a market cap just below $400 million. You went public in November. Talk to me about the timing there and the decision to come into the public markets.
When I first started this business, some of my ideas were crazy because I wanted to build these over-the-top, luxurious premium venues. So I wasn't able to go raise capital. I had to finance it myself, which is what I did. But my hope and my goal from day one was to be fan-owned. Our company is obviously fan-founded because I'm a music nut, but I wanted to be fan-owned. And so the only way I could be fan-owned was to create a company that was publicly traded so that fans could actually own a piece of the music business. We're building the greatest collection of venues ever in history. And so I think there's a lot of people that want to be involved in that. When I went out to sell our Fire Pit Suites, in a matter of 14 weeks, they sold almost $40 million worth of Fire Pit Suites here in Colorado. And that told me that fans want to be involved in the experience. You always sell $10 to $15 million worth of Fire Pit Suites every single month. We'll sell over $200 million worth of Fire Pit Suites this year. And that tells you that fans want to be involved in the space.
Well, JW, really enjoyed this conversation. Happy Friday to you. That is JW Roth, the CEO of Venue. Meanwhile, let's get a check on these markets. About an hour into the trading session, we're a little bit lower on the day on what's been a very good week. The S&P 500 currently off by about 0.1% if you round up or down, whatever you want to call it. The NASDAQ 100 also lower on the day, even though you do have this rise in Meta shares and some of the other tech names. Let's get into it now with Bloomberg's Bailey Lipschultz. And I feel like we have to start with Meta.
You have to. And when the company unveils that they're going to spend $65 billion in 2025, primarily around AI infrastructure, this comes on the back of that big Stargate announcement that sent shares of Oracle soaring. We are seeing Meta outperforming up about 1%. It is the best performer so far this year. The year is young, but the best performer among the Magnificent Seven stocks. I find it interesting, Katie, that just back in 2023, Mark Zuckerberg coined it the year of efficiency, and now it seems like 2025 more than happy to open the checkbook and really invest in AI, which has been the topic of 2024. So you are seeing shares again up about 1% and kind of really one of the outperformers among big tech.
What can you say? Things change.
Yeah.
Also, we're looking at Texas Instruments as well. Another chip story there.
Yeah, chip story on the downside, though. This is coming after their outlook for 1Q fell short of what analysts were looking for. A company still working through some of those backlog issues. And really, when you just look at what management was talking about, really trying to kind of right the ship, if you will, in terms of their focus. Again, this is a company that doesn't sell those AI chips. So this isn't a NVIDIA play per se, or even an Intel in terms of the price and some of the margins on some of those products. But when you have results that kind of fall short of what expectations were, when you're talking down the quarter ahead, really the first big chip reporter here in the US, that's going to happen. And we can, again, see the stock down 5.5%, weighing on analog devices, NXP Semi, on semiconductors. A number of the group really under pressure this morning after a lackluster forward view.
Any commentary on the calculators?
No. I haven't used one since high school.
Yeah.
I don't know if I had one in college.
The Terminal has a decent one.
That's true. That's true. I wouldn't know how to use it anyway. I mean, in any case, let's talk about Eli Lilly and Novo Nordisk. I do know some math. Big news out of Novo Nordisk today. They needed some of the enthusiasm that we've seen over in Eli Lilly, getting it with these trial results.
Early stage results showing that they could deliver as much as 22% weight loss in that early stage trial. As you mentioned, this really has been a tale of two stocks over the last year in a race for the next generation of weight loss drugs. The big thing to keep in mind, though, while the stock is up, at least the ADRs are up more than 7%, on a 12-month basis, down 16%. That compares to Eli Lilly, which is up 23%. So you are continuing to see kind of moving across the spectrum in terms of investors positioning for who is going to actually really win. And again, this is a stock that's down 41% from its June highs last year. So really a small win for today, but the big question going forward is, can you continue to come up with better drugs, better shots, if not oral medicines, and can you get patients to stick on those? That was the big issue with their earlier data that sent shares lower last year, was people not being able to stay on the medication, which is kind of the whole point.
Bailey, real quick here, I'm really curious to hear a little bit more about